taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to Total Money Management. This week we're covering the week that was from October 14 to 18. Some key issues we want to talk about are the Euphoria meter. Euphoria meter. Euphorometer.
Maybe, I don't know. You could be right.
Euphoria meter.
You're English.
Country returns. We're feeling the heat. Comparisons a thief of joy and some US resilience. But I think we might kick off with a big issue, like always, which is while China struggles, the US is booming. We spoke about it briefly in the last podcast. But for all the complaints about the government deficit of about 6%, GDP is running at about 6%, which is amazing. And what are China going to do? Like, how are they going to fix this? Because their real estate market's gone to shit. Everything else seems to be not working for them.
Yeah.
Exports are exports seem to be staying consistent, but we're not convinced that that's going to continue over the next 5 to 10 years.
Yeah.
So
basically, they're in a spot of bother, lad. But seriously, they grew. The figure came out yesterday, I think, being October or whatever, 19 or 18, 17, somewhere around there. They're growing at 4.6%.
China.
And it's funny, because you'd be thinking, man, I would love to grow at 4.6%. But they've reached the point that we've been talking about. They've reached the Japan point, right, which is China's debt to GDP. You know how last week we were saying Australia's 180, right? Now, that's just household, but the Australia's government is small in debt terms, right? So it might be, I think the Australian government is like, well, it's in surplus, but it might be 40, somewhere around there. Japan is 300. So it's 300% of GDP is in debt. So what's happening now is the property market's falling. They're trying to prop it up. But this is why I say you cannot do that, because if you could, the Japanese would have solved it. And if the Japanese would have solved it, then the Brazilians would have solved it when they did this model. And if they'd have solved it, the Russians would have solved it when they adopted the same model. So what I'm saying is these models of economic development have internal constraints, right? And once you hit the wall, that's it. It's all over Red Rover. So China has basically hit the wall. And what it's doing is, instead of saying we need to pump consumption, and that means we need to raise wages or give Chinese people money to start buying the stuff we're making, because Xi doesn't like that. He calls that welfarism. So what he's saying is, no, don't give the workers anything. We'll just export more stuff. We're over here going, dude, we don't want any more of those EVs. Stop sending us the EVs. Stop sending us the cheap steel. Stop sending us the cheap everything, because we've got problems of our own and we know that you should be reforming your economy. And so you've got, what is it? Immovable object meets
something force.
Something force. And so this is why you're getting the deglobalization. And again, this is not the first time. This is what happens, right? The countries get out of balance. Japan has been going for 30 years with an enormous amount of debt just gradually whittling away. So the Chinese are there's only really one or two answers. And they're continuing to dance around it. So now they say, all right, we'll get the banks to hold less capital in reserves. So that frees up reserves so they can lend some more. Well, okay, but nobody wants to borrow anymore because property's not the place to put your money anymore. So they then said, all right, well, look, we'll give a bucket load of money to these developers to finish off these unfinished apartments, right? Well, what's the point if they're finished, if nobody wants to buy them, right? So, again, they're trying everything they can other than doing what they should do, right, which is give the people more money. But they won't do that because that's what I mean. Xi doesn't want to raise wages. That makes their exports less competitive. That means less exports, boom, boom, boom.
That's what's happening in the US, right? They're spending a truckload of money
Yep.
And they're getting a truckload of growth.
Yep.
But no one else is doing that at the moment.
Well, the government, this is the important part, Jacob. The government is spending a lot of money in the US, right? But it's spending it productively on the Inflation Reduction Act, right? So what I'm saying is it's not giving you the money to go and buy a property, which is unproductive. They're saying, no, Jacob, you buy us, you build us a semiconductor factory, right? That's what's going on. You build us some more of our latest, weapons that we want, right? And so you're going to see more and more of this where the government says, we will give you the money, but here's where you're going to spend it, right? You're not going to be allowed to just fritter it away on speculative financialisation, because we've seen the problem with that over the last 30 years, which is a huge income inequality disparity, right? And you can't keep just as we were saying before, you can't just keep bloody well selling everything. Hospitals, bloody water, houses, as soon as someone creates something, they go, right, how do we financialise it? Oh, I got an idea. Let's get 200 mortgages and shove them in an ETF and we'll call them, we'll get people to buy them. Everything's financialised.
Yeah.
And that's why it's, the US is now turning by saying, listen, if you guys are not going to let our exports into your country, no problem. We don't want yours, right? And the problem is China, Japan and Germany are going to have to deal with it because they're the ones that have been fleecing the US by saying, we're going to send you all our stuff, but we don't want your stuff. Well, that only goes for so long until they go, listen, dude, they don't want our EVs. Well, give them the EVs. No, they don't want them. And that's why Trump is saying, I'm going to have a 100% tariff on everything, right?
Well, the wages are rising at 6% as well. So they're creating factories and things like that. They're making more jobs and wages are rising above inflation.
People are feeling like they're making progress.
Yeah. Because the wages are rising again, right? So people go, okay, all right, things are doing, it's not too bad. Yeah, there's a bit of inflation, but, wages are rising and they're building factories and, my young Tommy will probably get a job down the road there, it's all right. And that's why I'm criticising Albo and Chalmers, because they're sitting on their bum not doing anything.
Yeah. And most people think government spending money is a dirty thing.
Absolutely.
Right?
Absolutely.
Our kids are going to have to pay for this.
Yeah.
What are they doing? They're ruining everying.
Well, apparently my standard of living, which is 10 times better than my father, is apparently me paying for my father's debts. So, if that's the way it works, bring it on. I mean, every generation's richer, right? It's just all this bullshit about, the kids will have to pay for the debt. Really? Well, England after the war had, enormous debts. They were still doing all right for the next 20 years, next 30, next 40, next 50. It's a lie. Because governments are not households. Governments are not constrained by money. Now, they can create inflation, but they're not constrained by, Tom, we've run out of money.
Just print more.
Well,
it's not backed by anything.
Yeah. But as the government says, we're going to do that and we're going to build productive assets, then that actually adds to economic growth.
Yeah.
Right? Because you now say, well, listen, they built that road and now we can build houses and factories along that road and create economic growth. Okay, good stuff. But if they give it to you and you say, I'm just going to go and buy Tom's existing property for more money, well, that doesn't do anything. Right? Because you haven't made, GDP is what you produce. And if you haven't produced anything, it doesn't go to GDP.
You've added nothing to the economy. You haven't created a job. You haven't,
You just paid more for
things
something.
go around, really, yeah.
Yeah.
Get it. All right, Monday, the euphoria meter.
Yeah, this is the euphoria meter.
Or the euphorometer. However you want to say it, Steve.
A lot of euphoria.
Mate, I don't know who came up with it, but I like it.
Well, it's at all-time highs, right?
Well, yeah, that's it.
We're all euphoria. Must be the cocaine, eh?
Look, we're actually up above .com.
What's
levels.
that?
We're up above the .com levels. Right now.
Yeah.
So,
look at that. Cape is at 37.4.
So every time it's reached this level, it's tended to stagger and then fall a little bit, or fall a lot in some cases.
Yeah.
2019. I don't like talking about 2019 as a bit of a reset because I agree with you. I don't think it was.
No, I don't. The Cape fell to 23. That's not exactly screamingly cheap, is
Yeah,
it?
so
It
people
came back in a year.
Sorry?
And it all came back in a year.
It came back in about a month.
Yeah,
Yeah.
just V-shape. So people are saying, "Oh, the bull market started in 2021 or whatever,
Yeah, yeah.
2020." No, it probably
I
started in
don't think so.
2008,
Yeah. Yeah.
2009.
I agree. It my argument is you don't get a bull market from a cape of 23. It's just that it fell from 33, right? So anything that falls 30%, you go, man, that must be cheap. But if it's 100% overvalued, you go, no, it's just still overvalued. It's just fallen.
Yeah.
Do you see what I mean? Right? But the tendency, this is a buy the dip mentality. Look, the market's fallen 10%, you should buy the dip, right? And it's like, yeah, but should I buy the dip if the cape goes from 37 to 35? And it's like, yeah, buy the dip. And it's like, maybe.
It's it's micro thinking rather than looking at the next 5 or 10 years.
Well, it's just paying attention to valuation. Okay, so the strawberries are not $25 a punnet, they're now 22. Oh, dive in. Well, no, they're not because they're still crazy expensive.
If you wait 6 months, they'll be $3 a punnet.
Yeah, they'll give them away.
Yeah. Tuesday.
When the US has had a good year, the rest of the world generally follows.
Look at China. 47.1 in 2024.
Not bad, is it? Mind you, you've got to remember, this is in US currency. So, there's, what do you call it? FX.
If only we were talking about it a year ago.
I mean, it was cheap. It's done well lately, right?
Yeah.
China?
Yeah.
Yeah, but it's come back a bit. Hasn't it fallen about 15% this week or something?
I haven't checked it this week, to be honest with you.
I'm pretty sure it has.
Unsurprising after the 25% gain the week before.
Yeah. Yeah, well, we did say. Now, I'm more interested in looking at the ones that are red,
Yes, Mexico,
right?
Brazil,
Which
Vietnam.
is Indonesia, Saudi Arabia, South Korea, Chile, Vietnam, Brazil, and Mexico. So there's a couple of good ones in there.
Okay, so just real quick before we go on the 10th of September, China was at 40 US, the MCHI fund. So 10th of September, $41, and it went up to $60 on the 7th of October.
Beautiful.
So 50%.
What is it now, though?
Weeks.
What is it now?
It's at 50.
So it's still the same?
Well, it's still up 25% from a month ago.
Right, okay.
But it has dropped.
Right, yeah. I
from
thought
60.
it dropped this week or so.
Find the valuation.
It goes up the, what is it? Up the elevator, down the escalator, or vice versa or something?
Up the stairs, down the
Elevator.
off the building.
Something like that. Righto, Wednesday.
Oh, wait, I'll keep up with this.
Oh, come on,
There you
come
go.
on.
S&P.
Get with it.
Energy sector valuations. Energy's still looking cheap compared to the S&P 500, which we've obviously been talking about for quite a while now. If any of the current geopolitical issues catch fire, we could see a lot of action in oil markets.
Absolutely.
Can you go into why?
Well, because,
Supply and demand.
no. Well, yes, it ultimately is. Oil is about $75 a barrel, right? And I think it's being kept cheap because of the US election, right? No president wants to go, hey, good news, oil's at $120 a barrel. People are going, bloody, petrol's like $5 a litre, it's awful, right? So what they do is they release it from the Strategic Petroleum Reserve, right? And to keep the market down. That's why they're not going to interrupt Iran too heavily with sanctions, because if they do, oil gets taken off the market. If they actually enforce the sanctions against Russia, oil becomes expensive. So Venezuela, right? The Venezuelans had an election, right? Maduro. Now, Maduro lost. So Maduro says, yeah, stuff that, I'm not moving. So normally the US would say, hey, listen, sport, get on the phone to Maduro and tell him if he doesn't leave office, we'll bomb the shit out of him. Nah, they're not doing that. Why? Because Venezuela exports a lot of oil, right? And if they do that, you're going to get trouble in the oil markets, right? So I think what they're doing is they won't attack Iran. They're just trying to keep the oil price down until the election. That's why I'm a little bit worried about next year, because I think whichever way the election goes, they're going to say, righto, the election's over. I'm here for 4 years. Right, let's get back on the map. Right, go and tell up the Iranians and the Venezuelans. Right, we'll go and start doing that again. And you've got to remember, the US is now a net exporter or generally close to net exporting. So in other words, it's actually sitting there going, we'd love oil at 110 because we're selling it, someone else. So
I've got a pop quiz for you. How many million barrels are in the Strategic Petroleum Reserve?
now,
When in doubt, 7.
7 million?
7 million. Dream on, mate.
Is that your answer?
7's the default number. For
7
me, if I have
million.
no idea.
It's usually about 20 million.
Yeah, I wanted to say 21.
I'd say 8 billion.
8 billion.
Yeah.
Miles off. So there's 714 million barrels in the Petroleum Reserve.
I got 1 0 wrong.
And to put that into perspective, that will fill
About 3 months.
45,500 Olympic-sized swimming pools. Just to put that into perspective.
Make it really hard to swim, though.
It's the size of Lake Geneva in Switzerland.
Oh, that's good. I don't know how bloody big Lake Geneva
Did
is.
ChatGPT get you all that?
Unethical.
Did ChatGPT do all that for you?
ChatGPT did that.
So what is it? It's 800. I know they've released a lot.
714 million barrels.
They don't mind it being a little bit lower now because they've got their own oil sources, so they can let it run down. Because before they used to import it, right? Well, if you said to the US, we're not giving you any more oil, the US goes, oh, hang on, we're running out of oil. But now they've got their own source. That's why, is it in the newsletter? What are we in? October. The October newsletter, I talked about energy sources and books and stuff because it's the fundamental basis of everything in the world economy. And when oil changes, it ricochets through everything. Right? Because oil, everything is done with oil or gas or coal, right? When the Americans go, we were importing oil, now we're exporting, it changes the whole global dynamic, right? And that's what's been going on. There's that plus the globalization and the China and stuff like that. So interesting times.
Unreal.
Go check out energy. Thursday. So we'll talk about Australia's economy. It shares the same characteristics to the US economy, mainly because we just follow what they tell us to do. But the total value of the residential dwellings are 10.9 trillion, and the dwelling value per capita is 408k, and population being 26.7 million. So what are we trying to tell people here? The US is 345.4 million. Total value of residential dwellings is 70.9 trillion.
What I'm trying to say there is...
They got 10 times more people, but their property's only 7 times more expensive.
What I'm trying to say to people is if you have a system, Australia, England, the UK, Canada, and New Zealand, right? Think of those 5 countries. What have they got in common? They got the rule of law, they got corporate governments, they got open markets, right? And they got basically floating exchange rates. So they're all generally the same. Right? They got a welfare state, we got a welfare state. You know, they got taxes, we got taxes, blah, 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 right? So if you look at it and say, well, these places are basically the same, if something was really crazily overvalued, you'd be able to look at the other places and say, well, man, their house prices are not on fire. How come ours are? Right? Because you're sort of doing apples for apples. Right? You can't do this with China because the government's in the system, they don't have a floating exchange rate, they don't have liquid capital markets, right? So it's like doing a comparison between 2 companies in the same industry, right? Coca-Cola and Pepsi. Okay, Pepsi's at 30 PE and Coke's at 15. Oh, well, what's going on there? Right? So you have to look at the difference. So what I'm pointing out here is if you look at the value of residential property in Australia, it's now hit 11 trillion. Our GDP is roughly about 2, right? Maybe a little bit more. So it's about 5 times GDP. The US is about 2 times GDP. Right? So you see what I'm talking about? What I'm saying is you look at it and going, man, either the US is really cheap or Australia's really expensive. And as we did last week, what you can see is Australia is really expensive because we've got a huge household debt level.
Yeah. Well, we know that they're not We know that they're not really cheap, that the US is really cheap.
Well, the other thing that surprised me, I must admit I'm a bit surprised, is that the US households don't actually have a lot of debt, right? So they can, dare I say it, leverage up, right? Whereas if you look at our households, we've got a lot of debt. So that's why our residential properties are high, right? And that's what I'm trying to get across to people. When you look at cross valuations and stuff and you go, hang on, something's not right here. Why is Australia's property so high? Immigration, land planning, yeah, I get all that. But it still doesn't mean it should be 13 times income.
Oh, dear.
Right? So it's just, I'm just trying to point that out as a way for people to, and I'm talking to investors, right? So by just simply saying, listen, some things are cheap and some are expensive. If it's expensive and you think it can go on, hey, by all means, batter up. But just be aware that you're taking a bit of a risk in comparison to what, when you look at other metrics and you go, man, that looks expensive. Jacob, you were saying last week, they look at the yield. How's the yield? Oh, the yield's really awful. Okay, well, why am I thinking about buying this thing?
Yeah.
Right? Oh, well, everyone else is buying them. Oh, well, they must know more than I do. In we go, and the bank will lend me money. Right?
And someone gets left with the bags at the end.
Well, they always do. It's just that it's been going on for such a long time that you get, this is it's the new normal. Do you know what I mean? Like you just get used to it being really expensive. Oh, yeah, it's really expensive. It's really expensive. And then when it goes up again, you go, yeah, well, it's really expensive. But you're not thinking, yeah, but I've looked at history and it's going to fall at some stage. You just get enamored to it, or what's that word, numbed to it. It's just like, yeah, well, we all know it's expensive. But there's people paying a lot of money for properties that may potentially end up losing 20, 30%. And we're starting to see a little bit of it.
Yeah. It's just a question of whether they can hold on to them for 10, 20 years.
Yeah. But even if you do, Jacob, you don't make money. That's
the yield shit.
Yeah, that's my point. If you pay too much for a stock, if you buy the US Cape now at 38 and you buy the US stock market at an all-time high, yes, you can hold it for 20 years, by all means. But please don't tell me you're going to make 8% per year because, you're not. That's the way history shows. If you bought in 2000, it took you 13 years to get back to where you were. Now, you can put in more money and all that stuff. I get all that. But the fact is, if you put a lot of money in 2000, it took you 13 years. If in 1965 you did it, it took you 16 years, right? Before that, there was some period where it was like 1929. It took you 52 years. Well, that's a long time to be waiting.
Yeah.
Yeah.
Right? So that's...
Always comes back to that argument, timing the market versus time in the market, right?
Yeah.
And there's no question that dollar cost averaging is better than just straight buy and hold, but you really do leave a lot on the table if you don't at least factor in valuation. And the most profitable way to invest is timing and rebalancing, of course.
Absolutely.
Which is, no one is going to pick the very bottom or the very top. But if you start that dollar cost averaging process
around there.
Yeah, around the bottom.
And that's even 12 months early, even if you're 12 months early. Because if you look at all the tops, what happens is when you look at the top and it falls 5%, or it goes up, sorry, you look at the top and it goes up another 5%, people go, you missed out 5%, right? Well, let me give you an example. Right? I was listening to a podcast this week and the guy said, right, the Cape's really high in the US, but, it's gone up 38% since, I think, November or maybe 12 months or something, right? And he said, missed out on 38% of gains in the US market, right? Okay, well, that's one way of looking at it. The other way of looking at it is, well, what if you'd have invested in other markets, right? I think we showed that on what day was that? Tuesday, right?
Yeah,
There's other markets. Imagine if you said, I've invested in Malaysia and South Africa and stuff. Like, man, you only made 22% or, stuff like that. So what I'm saying is it's not 38% or zero.
Yeah.
Right? People invest their money elsewhere. Now, the other point is this. What happens if we come back in 12 months and that 38% turns into minus 15? is he going to come back on his podcast and go, man, you're a dickhead buying it that at 38%. Why didn't you rebalance, dude? You know,
I sold.
but that's what I mean. So it's not about the point in time. It's about how you're rebalancing and allocating your money. Right? And yes, you may well be up 38%. Congratulations. But you can come back in 2 years and go, now I'm down 10.
Yeah, what's your plan?
I actually think that slide's awesome because it's so funny. Even though right now China is at the top of the leaderboard for total returns year to date, that has all happened in the last sort of 4 to 6 weeks.
Well, yeah, but as I said, there's currency in that as well. So
of course, but
currency fluctuations. But yeah, you're doing all right. You're doing all right.
Yeah.
You're doing all right. Look at Argentina. They got that bloody mad idiot over there, and it's still up 30%.
Well, but
Because it was cheap.
that reinforces the value argument.
Well,
You know?
yes and no. You've got to be a little bit careful, as I said, because there's exchange rates there, and you've got to balance that out. But generally, yeah, if you buy cheap stuff, generally you're going to do all right. Well, you're going to do all right better at caper 5 or 10 than you are at a caper 35.
Yeah. There's
Right.
a difference between good value and cheap because we're not
Yeah.
talking about specky miners, Jacob.
Yeah.
Yeah, well, let's not talk about
How
that.
are those specky miners?
I've been out for ages. Don't worry
Mate,
about me.
I feel your pain. I've got a graphite that I'm holding at the moment. It's down 80%. But the good news is it went up 10% on Thursday.
Give you
So
a bit of a
another
sugar hit.
790%, and you guys will be thanking me.
Well, in the same breath, China's gone up a bunch, so can't complain. And that's why asset allocation is important, right?
Yep.
Because not all your cash is in this
In one,
this 80% thing that you.
yeah. Let me tell you, there ain't a lot of cash in it.
All right, let's wrap up on Friday. Where are we?
That one.
US households are in great shape. So just following on from the Thursday one, I think, and what we were saying.
Did we have that up last week? Didn't we talk about that last week? The Australia-Canada thing?
Yeah, we spoke briefly about it. But this is just saying, obviously, comparing it to Australia,
Yeah.
the US can actually look pretty cheap, although we know that the stock market is expensive. Right?
Keep talking.
Where are you going? Steve's doing a squat.
Getting my glasses. Oh, Jesus.
So, like, this is in my mind, the way I look at this, or my take of this, it's a bit of a false sense of security, where we know that America is expensive, or the stock market at least is, but the households are actually relatively cheap in comparison to other countries. But when you've got wage growth and everyone's in a job, your private debt, your lending is obviously going to increase, and people will start to buy big ticket items like houses and cars again.
Well, it goes back to the stock market's not the economy, right?
Yeah.
And it's funny on that, and I was actually meant to kind of add this to the end of the Thursday's point. We get people write to us who have argued against PE ratios, saying that's actually to them a signal. High PE is a good thing.
Yeah, buy high, sell higher is that argument.
Yeah.
Best of luck.
Terrifying.
Well, it works if
It
you do
worked
it.
with Tesla and Nvidia, so it probably works with everything.
And that's why I said in the newsletter, we said, well, you got 3 choices. Go with the momentum. I got no problem with that. But you just got to, as we said, Buffett says, go to the party, just dance close to the door, right? And that's why you might use a technical thing like the 200-day moving average. Okay, if it hits there, that's it, dude, I'm out. Because we know the bad stuff happens below that. If the cape's at 10, who cares? If the cape's at 37, you really want to care, right? Yep. And especially after the bull market, which is up about 450%. You've got to remember in 2009, the S&P is now 5,800, okay? What was it at the bottom, 2009? Have a guess. No, don't look.
2000.
Have a guess.
1,500.
Righto. Jacob? Tom?
2000.
Stop cheating. 666.
Oy. In 2000, at the bottom.
That's why you want one good bull market, right? Because you've made 450 odd %. Right? So, why would you then go, I'm going to take my money out? It's like, no. People will say, no, mate, it's going to keep going. I'm sorry.
Generally, you have a couple of bull markets in your lifetime as well, right? It's not as if you got one ever.
Yeah,
and that's it.
Every generation gets a bull market and they get a bear market.
Yeah.
So if you know what it's coming, then that's when you can be really clever, right? Because you can say, the world's burning, but the Cape's at 7. The earnings yield's 10. Okay, I'm going to take a chance. Right? And away you go.
Oh, look at the bonus section. The Mount Everest of NVIDIA compared to Cisco in 2000. Jesus, look at that.
Yep. Not bad, is it?
There's only one way down, though, isn't there? So what's this? Enterprise value is percentage of GDP. So NVIDIA is 11.7% of GDP as of July.
That's of total US GDP.
Yeah. It's outrageous. Huh?
It's just crazy.
It's more than most countries.
It's dead set crazy. US GDP, I think, is around 30. I think it's about 30 trillion. Right? Australia is about 2.5. Right? NVIDIA is as big as Australia. Is bigger than Australia. Its market cap.
Wasn't it double at one point? I think
probably.
NVIDIA it had gone up in a month or something, equivalent of our entire GDP. But at one point it was double. I think I remember. I could have dreamt that one. But
it wouldn't surprise me. I mean, but look at it.
Outrageous.
Well, you'd have to look at that and say, how much further can it go?
22?
Well, it could do.
It could be 100.
But this is why I was critical of people with Elon Musk when they were going, Tesla's going to be worth 20 trillion. It's like, dude, that's like 2/3 of the US economy. Stop dreaming, right? Do the numbers. That's not going to happen, right? It is absolutely insane. But that's the way people think. Now, I hate to criticise it, but people saying, Bitcoin's going to be worth $1 million. It's like, really? Well, it's at 68,000. Just do the maths to get to $1 million, right? It would be, mate.
I'll be riding that train all the way home.
Well, you guys will be rebalancing, so you'll be okay. You'll be telling me, I made 100% in Bitcoin again. And I'll be sitting here at 72 going, yeah, well, it's going to fall, you go.
Yeah, but I have my principles.
We've got a good framework, Steve.
I want to talk to you about the Cape ratio. Yeah, shut up, Steve. Get on with it. Righto, short story.
China's turning Japanese. Apparently, whatever that means.
Well, yeah.
The first thing I read.
You guys remember the song, don't you?
No.
What?
No.
Don't sing it, please.
What song? No, actually, you know what?
I'm not going to sing it, but I'm not even going to tell you what it's about. What I'm saying, look, read the Charlie Munger quote. I didn't get rich by buying stocks at a high price earnings multiple in the midst of a crazy speculative booms, and I'm not going to change. And all I'm saying is you've got articles there where, that brick place in Sydney is $4.6 million.
Oh, what a dump.
Wow.
Imagine if you bought it. I mean, I don't know. God, that's got to be money laundering.
In Kensington, yeah.
But on the right-hand side there, what hand's that, Stephen? That's your left. Why Australian homes are now top target in world for Asian investors. That's really, really important. And the reason why is because in our property podcast special, that's part of the reason why we've got expensive property. Not because of foreigners, as in Mrs. Nakamura from Japan buying a property, but the way the capital flows, right? The way the money flows around the world.
Well, from what I understand, we don't really vet how people are paying for them either. So it's
we have a light touch regulation, Tom.
Yeah, so it's a easy way to launder money.
Yeah, absolutely. Now, at the top, China turning Japanese. What I'm saying is what we talked about last week, right? They've used that system. They've now, they can't wave a wand and make everything good. Okay, they can't do that because, again, the debt's the problem. And that's the other article there with Pettis saying, China's total debt continues to rise rapidly. Outstanding is equal to 310% of trailing GDP. Right? So you think we got a problem when it's 180. They got a problem. They got a shitload more trouble at 300.
So
and that's
they're
what I'm
kind
saying.
of ahead of where we are.
Yeah. And that's what I'm saying. They just can't keep ramping it up. Right? And that's why I'm saying with Australia and the household debt is 180. We just can't keep ramping up debt because eventually you go, guys, there's no one left to give a loan to.
And everyone's miserable.
And everyone sobers up and goes, I don't think that house is worth 4.6 million. Right? That's why I'm saying that's what goes on. And then you've got the one next to Charlie Munger saying $1 million mortgage misery burbs. There's a heap of people out there with a bucket load of debt, right? And I think you were talking about it last week, Jacob.
Or we're just having people reach out to us that working banks saying that they're seeing people's savings accounts dwindling because their mortgages are too high. Like, it's not us just making bullshit up. Like, there are people saying, hey guys, we're agreeing with you. This is what I'm seeing in the industry. And I'm not talking about the top 1% of people that are doing really well. I'm talking about the majority that aren't, that no one hears about.
Well, I think it was last week we were saying about the winners, right? You hear about the winners, right? In that conversation. Very few people will tell you they're under financial stress and they're doing it really tough, right? Because especially if you've got an investment property or one or two or three or whatever, and you're really struggling. Look, I understand renters who say, oh, well, stuff the landlords, they're blah, blah, blah. Well, okay, if I said to you, hey, listen, let's swap places. Let's get you out of the rental market, but let's make you Tommy, who's got 3 properties, and he's come up with 10 grand a month now that rates are rising and, the market's not going up. Do you want to be Tommy? Now, most people will go, no way. And so that's why I'm a bit sympathetic to everybody involved, because it's really, really difficult if you're not doing well and you see a way out, which is to speculate, right? Everyone takes a chance, right? And a lot of people are just following everybody else who, mate, they got 4.6 million for that property. What?
And at this point, it's a recipe that's worked forever.
Absolutely. So
it feels like ever.
Yeah, so that's why I'm saying there's a lot of people out there, but you're not going to, they're not going to have a slogan these articles are starting to get into the mainstream media, right? So what we're doing now is we were hearing from the renters going, man, this rent is killing me. Now we're hearing from the landlords going, now the mortgage rate's killing me. And as we discussed last week, the RBA has basically said, nah, we're not cutting rates until at least April. So now the landlords are going, right? Because they've got to continue to find the money. And like you said, Jacob, they Noel Whittaker said to me 35 years ago when he was giving presentations, right, when I was a manager out in the regions. And Noel Whittaker said, I remember it so clearly, people will do anything to pay their mortgage, right? Bread and water, toast, skip meals, and they're doing all that. And they're doing it to pay that bloody mortgage. Now, it would be different if you were able to say, this is killing me. I'm going to sell. I'm going to get out of it, maybe potentially break even, and I'm going to rent, right? And there's heaps of rental properties. Rents, I can manage the rent, no drama. That's a real problem because, there's no bloody places to rent.
And rents are insane.
Yeah, so it's not as if you can go, oh, God, I feel better now. At least I'm, that was a bit of a bugger, but at least I'm renting and it's okay. You can't even do that now.
Well, you see more and more people. I mean, my sister, I doubt she listens to this, so it'll be fine, lives with mum. She's 27 and she's in England. She can't afford to get a house. She's got a decent job and everything.
And they wonder why demographics as the birth rate are low. I'll tell you why that's low, because nobody can afford to be with anybody to buy a property to raise a family.
Yes.
Look, it's just sucks. Anyway, ciao.
Ciao.
It's just awful.
Well,
but it's good weather. Get to the coast.
No, I was going to, finishing up on the chow, avoiding losses are the way to make more money. And that means selling and rebalancing on a regular basis, even when it's going up.
Yes.
Especially when it's going up.
Absolutely.
So, do you want to kind of talk us through the chart we have here, Steve, and the main data points we should be looking at?
Yeah, just there's bull and bear markets, right? Don't be greedy. Don't be too fearful at the bottom, right? Look at history. It goes up and it goes down. All markets, property markets, bond markets, stock markets. Yes, folks, if you're going to write to me and say it, that it was, 40 years, you've made lots of money, or since 1870, that's good. If you're 146, you've done well. But other than that, you've got to run with the cycles, and you've got to know when things are cheap and when things are expensive, right? And
here.
the US economy is going really well. but the Cape's at 37. So like you said before, Tom, the stock market's not the economy. And like we've said previously, I think we're heading into a period where you're going to go, yeah, my income's really good. Oh, man, you should leverage up. I'm doing all right. I'm okay. I got a wages growth and, I'm working down in that new factory in Texas there and, I'm safe there for the next 5 years and I'm getting a good wage and I've got a property down there and the wife and I got kids and, I'm taking the kids to baseball and it's pretty cool, right? That's what people really want, right? And that's where I think we're heading back to because we don't have enough labour. Right, so the employers are going to have to start coughing up to get staff. We've got a shortage of everything. Nurses, doctors, lawyers, all this sort of stuff. Now,
trades,
some of that will be catered for with AI, right? As it gets better, we'll be able to say, righto, we don't need, call centre people. I mean, much of it's AI anyway. But there'll be AI will drive some productivity efficiencies, but it's going to need to. Because the demographics is really, really awful. And the dependency ratio is falling. So you guys are going to have to look after old people like me. Right? Now, if you do that, you're going to say, well, you're going to be paying me a lot of money to do that. Right? Because you can't get AI to do that. That's a human service. Yeah, you can get AI to, cook a meal or do something, but not that sort of stuff. Right? And that's why I'm saying we're entering a period where unemployment will be low like we've got now, but the wages aren't that good at the moment, right? They're going to get better like the US, right? Because they're saying, right, we need you guys to, dig in and build a factory and, we need plumbers and electricians and we need engineers, we need semiconductor engineers, we need, the creme de la creme. And that's what's going on in the US. That's why it's going really well because the government have made a decision to stop getting the stuff from China. Now, it'll take a while, right? But it's in motion. And I'm talking a while as in 5 or 10 years. But we can't continue on with the way that it's been, right? Because, again, the income disparities are so large, right? Are so large. And the companies have this hold on monopolies. Well, they've got to be broken up. Right? Or, I must confess, or you can say, all right, well, yeah, we just stay like this in a bloody state of misery for, a large percentage of the population. But it hasn't happened that way in history. And you always get it when you get this imbalance between countries with trade. Right? That's why I say this is not the first time it's happened. And that's why I say you really got to learn about history because you look at it and go, oh, man, yeah, I see that. That's what happened in the 1930s. Oh, that's unusual. But then you go, oh, so it has happened before, right? So you've got a bit of a guide to say, well, what else has happened? Oh, well, America started, building all their stuff at home. Oh, that's what they're doing at the moment. And, they started giving people really good jobs. Oh, that's right, okay. And they started talking about, going after companies and corporates and, raising taxes and stuff. And it's like, oh, right, okay. That's why it's really important to read it because once you read it, you go, this is not new. This is just another turn of the cycle.
Mm. Just the majority of us haven't been around to see it.
There you go.
Exactly.
All right. Well, thanks for listening, everyone. As usual, if you're not already, please jump on the website, subscribe to The Week That Was so you can follow along or see what we're kind of talking to. I've also started posting blogs weekly as well. So make sure you jump on, check it out, subscribe, and keep in the loop. Thank you.
Cheers, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.